Hi, my name is Joshua Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 19th of February. And of course, we've just moved off the back of a week that saw a big focus on inflation, in particular, the US inflation causing a sort of risk off move as people realize that we're not necessarily going to see the US move back down to 2% too quickly. And things looking somewhat different over in the UK. We saw a minus 0.6 reading on the monthly figure for the headline CPI, minus 0.9 on the core reading. So certainly the pound really coming under pressure in a week that also saw the UK fall into a technical recession with that minus 0.3 reading on the Q4 GDP number. But what have we got to contend with this week? Well, first and foremost, I wanted to give you a big picture overview of some of the main items to be watching out for. I would say the beginning of the week, the first part of the week, really has a focus on central banks. We've got the likes of the RBA and the FOMC releasing their latest monetary policy minutes. And that's really going to give us some flesh on the bone in terms of the potential outlook for interest rate cuts. And of course, that is a key driver of sentiment, particularly within the FX markets at the moment. We also see inflation data coming out of Canada. That is going to be an area we'll be focusing on today. Then Wednesday night coming into Thursday, we see a big focus on PMI data. I've trimmed down a lot of it here just to put the composite readings in, but essentially we see PMI data coming out from Australia, Japan, Europe, the US. And so that's going to give us a good sort of leading indicator of exactly how things stack up from an economic perspective. And then on Friday, we see that final reading for the German GDP figure, and we see that IFO business climate number. So a focus on Germany as we close out the week. In terms of the three themes for the week, the first is the US. We have a whole host of Fed speakers making appearances over the course of the week. Just eyeballing it here, we've got Bostic, Bowman, then we've got the Fed minutes, we've got Jefferson, Harker, Kush, Kashkari, Waller. I mean, it's going to be a massive focus for the week, and therefore it's really about trying to align market views and the views of the Federal Reserve. Now, bear in mind that we've moved from a position where markets are pricing in a March rate cut as the first rate cut to one where it's a May rate cut. And now markets are looking for June as the first rate cut to come into fruition. And so that repricing that has been taking place over the course of the last week has come to the benefit of the US dollar. It hasn't necessarily hurt markets too much because it's come alongside a move in terms of equity markets driven by earnings data. So improved earnings, improved outlook for equities going forward, that really overshadowed some of the moves that we saw around that repricing of the Federal Reserve's interest rate outlook going forward. In terms of what else to look out for, remember, we also have those PMI numbers coming out on Thursday. So Thursday, particularly important, but Wednesday night, we also have those FOMC meeting minutes. And ultimately, we saw a position where markets were also expecting 7 rate cuts this year. And we're hearing recently from Jay Powell and other Fed members that they're pointing towards 2 or 3. So again, markets now have reined that in. They're looking for 4 to 5. But do we see further reining in of that? Or have we pretty much seen most of that done? And therefore, we might see a sort of risk on play, a move away from the US dollar if that is the case. So it's really a question mark of whether we see Fed members try to continue to rein in those expectations. In terms of the market, I wanted to watch for this one. It is the S&P 500. Now, my advice for people trading is try to find something that goes in one direction and follow that direction. So the trend is your friend, so to speak. But generally, people will quite happily trade a market that is highly volatile or lacks any sort of true underlying direction. And for me, I think they're making life difficult for themselves. Now, this is the weekly chart, and what you can see here is there is certainly a trend within this, because pretty much every single week since November, was the back end of October, apart from one, has seen this market move towards the upside. And notably, the week just gone has seen a big decline at the beginning of the week when we saw that US CPI report. And now, where are we? We're heading back up into those prior highs. So really, this is a trending market that is reliable enough for you to be able to say when we see those pullbacks, I think there's a good chance that we see more of the same come back into play, which is essentially more upside. That's exactly what has been playing out as we enter a new week. And therefore, this latest pullback and the low that we had here at 49.20 provides us with a new swing low. In particular, if we break through the 50.49 level, then you can say, okay, we've got a new swing low. And if you're in a trade here and you're looking for stop losses, it's this creation of higher lows in particular that tell us that we're still on that train, still on that upward trajectory. And once we break down through, say, your prior swing low, on this occasion 49.20, that then points towards a wider pullback coming into play. But until we break through that price swing low, and on this occasion this week we saw a pullback, but we didn't break the 48.45. Until you see that swing low taken out, the expectation is that we're going to see the trend maintain its trajectory. So S&P 500 in relatively good shape. And I think that, we've been talking about the fact that this market and US markets as a whole have really been taking things in their stride, despite the fact that we've been seeing this repricing towards less rate cuts from the Federal Reserve. Well, thankfully, that's happened during a time when earnings have somewhat overshadowed what's happening in terms of the Federal Reserve and the outlook on monetary policy, because we could actually find ourselves in a position soon where markets are pretty much pricing the correct amount. And therefore, that in itself could be a relief, and that could take some of the strength out of the US dollar and provide another base, the basis for another move higher in terms of risk assets. So arguably, a lot of the heavy lifting in terms of driving down those expectations have already occurred. And thankfully, they've occurred while US markets are reaching record highs. In terms of the next market I wanted to show you, it is the eurozone. Now, like I said, Thursday is the big day for PMI releases. We've got a whole host of them coming out of the eurozone, of course, building up into that eurozone number itself. But what's notable here is that we are expecting to see further gains across most of these metrics. So a growing confidence that we're starting to see these economies move into a better shape as we head into 2024. In terms of inflation data, we've also got that coming out on Thursday, but bear in mind it is a final reading. So this is a revision, much like that GDP number coming on Friday for the German economy for Q4. Again, it is a revision, so you don't necessarily expect to see too much. But we are seeing forecasts of a tick lower on that headline inflation rate down to 2.8%. The outlook for the ECB remains one of weak growth and inflation that soon will break back below that 2% target. In my mind, by my projections, we're going to be breaking through 2% in the near future, before the US, certainly in my mind. And so that provides the basis for potential weakness for the euro. However, if we do start to see strength in terms of these PMI numbers, which is being projected, and we start to see some of the pressure being taken off in terms of the weak sort of growth story and what that does to the ECB, that could provide the basis for near-term upside because of the weakness that we've seen for some pairs in particular for the euro. Bear in mind that we have actually seen ECB members pushing back against the idea that we're swiftly going to see a rate cut, in part because they think that wage growth is elevated. And so that's something to be keeping an eye out on too. But I wanted to show you a pair that actually looks like the kind of thing that could move higher if we see some improved PMI numbers, as has been expected. This is the euro against the Japanese yen. I'm showing you first and foremost here on the weekly time frame to show you the trend that's in play. Bear in mind, recently we've seen the Japanese economy falling back into a recession. We're seeing inflation pressures ease and wage pressures in a similar kind of trajectory. So the pressure on the Bank of Japan to do anything is easing. At the same time, even if they did do something, I think it would be one rate hike and then they're done. They're just moving out of negative territory. So not necessarily too much grounds for optimism for the Japanese yen. There's question marks around about whether we're going to see intervention from the BOJ, because of course we saw that dollar yen hit the 150 mark once again, but it hasn't been forthcoming thus far. So there is the possibility of that sort of volatility coming out of nowhere, but at the moment that's not what's happening. So if we break through this near-term resistance level 161.869, that then establishes this new lower low and points towards further upside coming into play. Here's the 4-hour chart, and so whilst that wider time frame gives us this big swing low at 158, we can of course look for the 4-hour charts swing lows and say, okay, 160.915. If we break below that level, we're looking for a wider retracement to come into play. But until that happens, this latest leg higher could pull back, you know, if we don't break it through resistance immediately. But whether we pull back near right now or whether we break through resistance and pull back, either way, the outlook for this pair does remain relatively constructive and bullish unless we break the 160.915 level. So euro yen, I think, looks a particularly interesting one, in particular if we're looking for a potential strengthening in terms of the economic picture in the eurozone. And then finally, I wanted to show you the Canadian data. We have inflation coming up. And of course, as we all well know, inflation has the propensity to move markets in a very significant manner. We saw that on Tuesday with the US CPI number. We saw it again with the UK CPI number. And we have the Canadian numbers coming up. We've got PPI on Monday, and then on Tuesday, we've got those CPI readings expected to move down to 3.2% on the headline figure. And that's despite a month-on-month reading of 0.3 that's predicted. Now, I would say that if you're looking at the outlook for a move back down to target for Canada compared to the US, they're in very different positions. I think in 6 months' time, there's a very good chance that we see Canada sub 2%. Annualizing out the last 6 months, you would essentially put us at 1.4% in terms of Canadian growth. So they are on a trajectory to get back down towards target, but the coming sort of 1, 2, 3, 4 readings in particular are pretty hefty. So this is one of those 4. This is where the disinflation, I think, really starts to kick in a more meaningful manner. So beyond this forthcoming number, we've got another 3 months of significant disinflation, and that should start to get us pretty close to that 2% target. So the outlook for interest rate cuts from the Bank of Japan seems more likely than the Federal Reserve in terms of that inflation trajectory, because the US just isn't on it, quite frankly, if you're looking at the headline numbers. But of course, people like to try and dig into a number of different metrics and just say, look at this one single element of it, look at the services sector inflation, or, you know, look at the super CPI. But ultimately, the Canadian economy is likely to see inflation continue to drive down, and notably 2.6 in that core inflation reading. Really, that's encouraging for the Bank of Canada, because it's significantly lower than the headline reading. And if you look elsewhere, the likes of the UK and the like, it's usually the opposite, that relationship. And generally, the core stuff is the kind of thing that the central bank can directly impact. It's the sort of wider things like energy prices that is more difficult for them to impact, and therefore they would be more likely to take monetary policy decisions based on what they can impact. And 2.6%, I think there's a good chance that we do see Canadian inflation moving back down towards target in a very near future, and that should be a theme for the week ahead. In terms of the market I'm looking out for, look, if we start to see further weakness in terms of the Canadian inflation picture, and if we're looking for the US inflation picture to remain a problem, which I do think is likely to happen, and we're looking for commentary from Fed members and the FOMC, which could further rein in expectations in terms of rate cuts from the Federal Reserve, because we're still not aligned in terms of the Fed outlook and the market outlook, that could provide us with upside for dollar CAD. Now, notably, we've been on this upward trajectory over the course of 2024 thus far. We've pulled back in on Thursday into a deep retracement. That's what I think it is anyway. and starting to see some strength. We're rolling over a little bit here, but essentially we're looking for this swing low down here to hold 134.127. If that level breaks, then let's go on the weekly time frame, then this latest rally looks like it could falter. But if you look at price action over the course of the last year and a bit, you can see that by and large, it all takes place within this zone here. So we're halfway into it, right? There's a good chance that we do, even if we're looking at the top end being more like here, there's still plenty of upside if we are to maintain that range. And so from a wider perspective, there looks to be room for upside. Over the near term, we have got a sort of bullish trajectory over 2024 thus far. And this pullback has moved us into a potential retracement. Let's draw the Fibonacci retracement levels on and see exactly where we stand here. So we've gone past the 61.8. We're starting to roll over, but it could be a case of just bottoming out around here. Maybe we need to come into the 76.4, which is at 134.53. But ultimately, unless that 134.127 level breaks, this latest pullback, I think, has a good chance of being bought into. So keep an eye out for this pair, because I think it's going to be really interesting. What with all of the commentary coming out of the Federal Reserve and with the inflation data coming out from the Canadian economy, we should be provided with plenty of volatility for dollar CAD. And given the wider picture showing room for upside, and given the near-term picture showing an upward trajectory over the course of this year thus far, there is a good chance that we see dollar CAD coming into favor once again if we start to see inflation moving lower in a meaningful manner this week for the Canadian economy.